Most people who end up with $5 million never made a single brilliant investment decision. They didn't time the bottom in 2009. They didn't buy Bitcoin at $300. They didn't launch a startup that got acquired. They simply refused to stop. That is the strategy almost no one talks about. Not because it's secret, because it's boring, and boredom doesn't sell. Right now, the average person feels further from 5 million than at any point in the last 40 years. Housing takes a larger share of income. Healthcare costs keep rising. Student debt follows people into their 40s. The old promise, work hard, save a little, retire comfortably, has started to feel like a story told by people who already made it. So the search for shortcuts intensifies. Crypto, options, side hustles that somehow require a full-time job's worth of energy. The louder the promise of speed, the quieter the only method that has repeatedly produced ordinary millionaires becomes. Here is how the system actually works. You pick a broad, low-cost index fund that owns a slice of the entire productive economy. Not a hot sector, not a single stock, the whole market. You decide on a fixed amount of money you can invest every month without changing your life in painful ways. Then you buy. Every month, when the market is roaring, when it is crashing, when the headlines say this time is different, you buy the same dollar amount on the same schedule. That is dollar cost averaging in its purest form. Over decades, the price you pay averages out. You automatically buy more shares when prices are low and fewer when they are high. No timing required, no genius required. The second part is automatic rebalancing. Once a year, or whenever your allocation drifts too far, you sell a little of whatever has grown too large and buy a little of whatever has lagged. You are forcing yourself to sell high and buy low without ever having to decide in the moment. Most people cannot do this with individual stocks because emotion takes over. An index fund plus a simple rule removes the decision. Now the uncomfortable math. Assume you start at zero, you are 28. You can put aside $800 a month. That is real money, but not life-changing. Historical long-term return of a total stock market index after inflation has been roughly 7%. At that rate, after 35 years, you are sitting on approximately 1.8 million, not 5. So the pure set it and forget it with modest contributions path rarely reaches 5 million for someone starting late or saving average amounts. To get closer to 5 million, you need one or more of three things: higher contributions, more time, or a period of stronger returns. Raise the monthly amount to $1,500 and keep the same 35-year window and the number climbs past 3.4 million. Start at 22 instead of 28. And the difference is staggering because the early years do most of the heavy lifting. Or accept that some decades will deliver higher than 7% real returns, and some will deliver less. The strategy does not guarantee 5 million. It makes 5 million possible for people who are not unusually high earners. That is the part almost no one wants to say out loud. The strategy works, but the inputs matter more than the method. Time is the dominant variable. Consistency is the second. The size of the monthly contribution is third. Everything else, stock picking, market timing, alternative assets, has historically been noise for the vast majority of people who actually reach seven-figure net worths through markets. Look at the behavior gap. Studies that track investor returns versus the funds they own show the same pattern year after year. The average investor underperforms the very funds they hold by 1 to 2% annually. Why? Because they sell after big drops and buy after big runs. They interrupt the compounding. The strategy no one talks about is not the index fund itself. It is the decision to never interrupt it. There is another hidden mechanic: lifestyle inflation. Most people who start saving seriously in their 30s increase their spending almost as fast as their income. The $800 a month becomes $1,000, then $1,200, but the house gets bigger, the car gets newer, the vacations get longer. The gap between what they could have invested and what they actually invested widens every year. The people who reach 5 million are often the ones who kept their living costs rising slower than their income for 2 or 3 decades. That is not a financial product. It is a character trait expressed through repeated small choices. Contrast this with the popular narrative. Social media is filled with 29-year-olds who claim to have turned $5,000 into $1 million in 3 years. Some of them are lying. Some got lucky once. A few are skilled traders in a specific environment that may not last. Almost none of them are describing a repeatable process that works for someone with a regular job, average risk tolerance, and no appetite for watching charts at 2 in the morning. The quiet path looks slow in year 5. It looks almost magical in year 30. The loud path looks magical in year 3 and often disappears by year 10. The risks are real. Sequence of returns risk means that if the worst decade of returns hits in the first 10 years of your investing life, the final number will be lower even if the long-term average is the same. Inflation can run hotter than expected for long stretches. A major depression that lasts 15 years would test the strategy severely. And there is the simplest risk of all. You stop. Job loss, divorce, medical crisis, or just pure exhaustion can break the chain of monthly contributions. Once the chain breaks for several years, catching up becomes harder than starting earlier would have been. Zoom out and the implications are larger than one person's portfolio. An economy where a meaningful percentage of the population quietly accumulates wealth through broad ownership of productive assets is more stable than one where most people are either deeply in debt or swinging for lottery ticket returns. It also creates a quiet political tension. People who followed the boring path for 30 years tend to view sudden wealth transfers or aggressive monetary experiments differently from people who feel the game was always rigged against them. The strategy itself is apolitical. The outcomes it produces are not. None of this means the method is easy. It requires a strange combination of patience and aggression. Patience with the market's mood swings, aggression toward your own tendency to interrupt the process. It asks you to look at a number that grows slowly for a long time and keep feeding it anyway. Most humans are not wired for that. We are wired for immediate feedback and visible progress. Compounding refuses to give either until late in the process. So the exact strategy no one talks about is not a secret formula. It is the decision to treat the market like a long-term business partner instead of a casino, to automate the partnership so emotion cannot sabotage it, and to protect the contribution rate from the constant pressure to spend more. The rest is arithmetic and time. The open question is not whether the math works. The math has worked for decades. The question is how many people, knowing the math, will still choose the slow version when every screen around them is telling a faster story. Most will not. The data already shows it. Participation rates in consistent long-term investing remain low, even among those who understand compounding. The few who do follow through rarely announce it. They simply keep buying the same broad index on the same day each month, while the noise grows louder around them. Over 30 years, that quiet repetition turns ordinary income into something that looks extraordinary only in hindsight. The strategy itself never changes. The only variable that decides whether 5 million appears is whether the person executing it lasts longer than the distractions designed to stop them.